When it comes to planning and saving for retirement, we often see people underestimate how much income they'll need during retirement. Therefore, they become overly confident that they have saved enough. Some people leave large sums of money sitting in the bank where they end up earning a low rate of interest, and inflation and taxes slowly eat away at the purchasing power of their retirement savings. Anyone can calculate that to generate $50,000 in interest income in a bank that offers 2% interest, they would need $2.5 million to do it. But since $2.5 million sounds like a big number, some are happy just letting their money sit in the bank. Many people mistakenly assume that once they retire, they will spend less money, but with more time on their hands to enjoy things like hobbies and travel, they end up spending more. Another thing people forget is that if they retire in their 60s, they might need income for another 30 years or longer. With inflation, according to the Bureau of Labor and Statistics, retirees could easily need roughly 3 to 4 times the amount of income at the end of their retirement as they did on their first day of retirement. A common place where many people underestimate how much money they'll need is healthcare costs, where the historical rate of inflation has been even greater. If you retire today in your 60s and the cost of full-time home health care is around $200,000 per year, after accounting for inflation, this cost could easily reach $800,000 per year by the time you reach your 80s. We often hear people say that the reason they need to keep so much money in the bank is either safety or liquidity. Ask yourself, which is your primary reason for having so much money in the bank, safety or liquidity? If it's liquidity, then how much do you think you really need? In a worst-case scenario, if you had to max out all your insurance deductibles, homeowners, auto, health, etc., and had to replace your roof all within the same year, we'd be probably talking about $30,000 to $40,000. And most people would agree that having enough liquid money set aside for emergencies is a good idea. But now let's consider the economic effect of having too much money in the bank. Suppose you have $100,000 sitting in a savings or money market account, and let's say that you are one of the lucky ones earning 2%. At a 2% interest rate, you would earn $2,000 per year in interest and would end up paying about 1/3 of that in taxes, approximately $667 per year. With an average inflation rate of about 4%, you would lose another $4,000 in purchasing power each year. After accounting for taxes and inflation, the net economic effect of keeping your $100,000 in the bank is that you would lose $2,667 each year, or about $222 each month. As strange as this may sound, economically the best thing you could do with this money is to spend it all today. Why? Because with the effects of inflation, you'd never be able to purchase more goods and services with this money than you can today. Obviously, we don't recommend that you spend it all today because we all need that money to fall back on. But speaking from a purely economic point of view, that would be the best thing you could do. So let's say that you walked into a new bank that you trusted, it had solid financials, and you felt confident that it would provide tremendous customer service. Just like in the old days, they would provide a free toaster with each new account opened. And the only fee charged was a small monthly service fee of just $222 per month. Would you open an account at that bank? Probably not. But economically, that's what's happening at your bank. It's costing you $222 per month to keep your money there. Now the question becomes, how much money do you really need to keep in the bank for liquidity purposes? By looking back to the worst-case scenario example, you could say in most cases anything more than $30,000 to $40,000 might be too much. Now, if you answered that safety was your primary purpose, you might be interested to know that you could earn significantly more interest than the bank offers without having to mess around with common stocks and stock mutual funds and all their inherent risks. An advisor that specializes in income-generating investments can help you invest in a manner that will preserve your hard-earned money while creating regular flows of income you can count on during retirement. By investing predominantly in income-generating investments, you can know with greater certainty that your income will be consistent while your principal remains intact. Other markets such as common stocks, mutual funds, and bond funds don't offer much certainty. If you're over the age of 50, we feel that it's imperative for you to focus on what's best for your financial future right now. By putting your money to work in fixed income securities, you could significantly reduce and even eliminate your exposure to stock market risk. This is good because the next bear market could leave the portfolios of those still investing in stocks in tatters. We've covered a lot of ground today, and you might feel overwhelmed by all the decisions that need to be made. Our clients take comfort in knowing that we specialize and focus our efforts in helping them navigate through the complexities of planning and living in retirement. We understand that everyone's situation is unique and there's never a one-size-fits-all solution. We encourage you to visit our website to find out more about our upcoming retirement workshops. Or give us a call at the number provided, and we'll be happy to schedule a free consultation with one of our advisors so we can prepare a custom-built retirement analysis for you.